Remains weak, Jane. We've got ISM data, ADP data coming out ahead of payrolls. Can we expect it to weaken further?
Well, it certainly could, and to be honest, I think this is all a reaction to the positioning that we built up earlier in the year. The market, particularly in February, became very long US dollars. It was then very optimistic about the prospects of US growth, and then also about the prospects that the Fed could step back and start paring down the quantity of QE. But of course, over the last few weeks, really since the last set of payrolls data, there's been a weight of disappointing US growth data, payrolls, retail sales, a lot of forward-looking industrial surveys, all suggesting that the US could be about to suffer another spring slump in growth. So the Fed today, well, is expected to perhaps discuss the extent of that slump, and it seems that Fed QE for the time being is set to stay. And because the market is a long dollar, it is therefore vulnerable to this type of news.
I'm interested in your target on euro dollar, because it seems that the market must be short euros given expectations of a cut from the ECB and the resilience we're seeing.
Well, that's right. I think part of that resilience is because the market's adjusting its dollar positions. The dollar is vulnerable. But again, the market is short the euros. We see this in the CFTC futures positioning. Now, this obviously is only indicative of part of the market, but the market certainly, and if you look at that, is short the euro. Cyprus, the market became short of the euro again. And because the market's short, that means that the euro, by implication, is a bit more resilient to the negative news. And negative news we've had. Well, the Eurozone, of course, has been in recession for a while now. Recent data has been poor again for a while, so the market is expecting a rate cut, but it is well priced for that.